Yesterday, we proclaimed victory. We announced to the world that the financial institutions had capitulated and that the era of price manipulation was over. However, today, communication channels went silent. The market price for silver currently stands at $62.30. It has maintained its position. It has not collapsed. On paper, your net worth is at an all-time high, but attempt to convert that value into tangible assets. Try to take those $62.30 and acquire an ounce of physical silver right now. I challenge you. Contact the largest wholesale distributors across North America. Reach out to the precious metal refineries in Switzerland. Call the minting facilities in Australia. Do you know what you will encounter? You will be met with a disconnected tone or a recorded message stating, "Due to unprecedented market fluctuations, we are temporarily unable to process new orders." We had cautioned you about this possibility. We foretold that the moment the price decisively broke free from commercial suppression, the ascent would not be a gentle trajectory. We warned that it would dismantle the existing financial machinery. Indeed, the machinery has fractured. What we are observing currently at $62.30 is not a scarcity of supply. It is a profound liquidity crisis. The entire supply chain for physical silver is fractured. Refineries are suspending all incoming orders. Wholesale distributors are rescinding transactions that were confirmed yesterday. The United States Mint is reportedly operating under an indefinite allocation system. The reason? The price escalated far too rapidly. It sounds illogical, doesn't it? One would expect elevated prices to stimulate increased market supply. This is the fundamental principle of basic economics. High prices incentivize producers to bring more goods to market. However, the silver market does not operate on the principles of introductory economics. It is a precarious structure built upon leverage. At $62.30, the protective financial mechanisms that enable refineries to operate have transformed into a self-destructive pact. In this presentation, which may serve as the most critical advisory I have ever delivered, I will meticulously detail the reasons behind the supply chain's paralysis. I will guide you through the predicament faced by refiners. I will demonstrate why holding fiat currency in your possession at this juncture represents the most perilous position. Furthermore, I will elucidate why $62.30 is not indicative of the true price, but rather the final recorded location of a vessel that has utterly disappeared from radar. If you are delaying your purchase in anticipation of a price correction, you have already suffered irreparable loss. The opportunity has not merely passed, it has been irrevocably sealed. We are confronting the absolute worst-case scenario. Let us establish the current reality on the ground as of December 11th. Typically, any market comprises two fundamental components: a bid representing the maximum price buyers are willing to offer, and an ask indicating the minimum price sellers are prepared to accept. When these two converge, a transaction is consummated, resulting in market liquidity. However, as of this morning, the silver market has transitioned to a bid-only environment. Millions of individuals are prepared to exchange currency, eager to purchase at prices of $62, $65, or even $70. Yet there is no corresponding offer from sellers. The sellers have vanished. This morning, I received a report from a significant contact within one of the largest precious metals distribution firms in Texas. This organization handles the movement of millions of ounces monthly. He conveyed verbatim, "We have suspended all sales operations. Our credit line with the bullion bank is fully utilized. We are unable to procure replacement metal for what we sell, hence we are temporarily deactivating our website." Consider this fact. Their core business is the sale of silver. Silver is experiencing an unprecedented price surge, and yet they are compelled to cease sales. The underlying reason is replacement risk. Envision yourself as a dealer. You possess a substantial quantity of silver eagles on your premises, acquired 3 months ago when the market price was $30 per ounce. Today, the price has climbed to $62.30. You could sell this inventory and realize a substantial profit. Correct? Incorrect. Because if you liquidate that stock today at $62 per ounce, you will possess cash. However, tomorrow, if the price escalates to $70, $80, or even $100, you will need to utilize that cash to replenish your inventory. If the price appreciation outpaces your ability to restock, your business will fail. You have effectively traded an appreciating asset for a depreciating currency. Consequently, astute dealers, those who navigated the market disruptions of 1980 and 2011, have recognized this inherent trap. They are retaining their existing inventory, believing the intrinsic value of the metal exceeds the immediate profit margin. This behavior precipitates a severe liquidity vacuum. The silver itself exists. It is stored in vaults and secured repositories, but it is inaccessible. It has been reclassified from available inventory to a strategic reserve, and this situation is now directly impacting you. If you visit online retailers such as AppMex, JM Bullion, or SD Bullion at this moment, you may encounter pre-order options with projected shipping dates extending to February 2026. I strongly advise against selecting these options. This constitutes an unsecured loan to a dealer who demonstrably lacks the physical silver. At $62.30, the tangible connection to the commodity has been severed. The root cause of this disconnect originates at the apex of the market hierarchy, the refineries. This is a technical explanation that is crucial for understanding why the price of $62.30 has destabilized the entire system. Most individuals perceive a refinery, such as Heraeus or Valcambi, as speculative entities that profit from price increases. This perception is erroneous. Refineries actively dislike price volatility. Here's a breakdown of their operational model. A refinery procures unrefined silver bullion from mining operations. Let us assume they acquire 1 million ounces. The process of refining this silver requires a considerable time frame, perhaps 2 weeks or even a month. The refinery operates under a constant apprehension that the market price of silver might decline during the refinement period. If they purchase at $62 and the price subsequently drops to $50, they face substantial financial losses. Therefore, how do they mitigate this risk? They utilize the futures market. The instant they acquire the physical ore, they simultaneously engage in short selling a commensurate quantity of paper silver contracts on the commodities exchange. If they possess 1 million ounces of physical silver, they will sell 1 million ounces of paper silver. This strategy is termed a perfect hedge. Should the price of silver decrease, they incur a loss on their physical holding but achieve a gain on their short position. Conversely, if the price of silver increases, they profit from their physical holding but experience a loss on their short position. Their objective is delta neutrality. Their aim is to profit from the refining service fee, not from fluctuations in the market price. This operational framework functions effectively when silver prices fluctuate by mere cents daily. It remains manageable when prices vary by 50 cents per day. However, what transpires when silver experiences an unprecedented surge of $2.50 within a single day, followed by an additional 50-cent increase amounting to several dollars the subsequent morning, this triggers margin calls. The refinery possesses the physical metal, but this metal is currently undergoing the refining process. It is not readily available cash. Simultaneously, their short position on the commodities exchange is incurring losses amounting to millions of dollars hourly as the price escalates to $62.30. The exchange authorities are indifferent to the fact that the refinery holds physical metal. They demand immediate cash to offset the losses incurred on the paper short positions. This is the crisis scenario. The refinery is, by all technical accounting standards, solvent, but it is profoundly illiquid. Consequently, on Wednesday, December 10th, as silver breached the $60 threshold, every major global refinery received an urgent communication from their brokerage firm. The demand was unequivocal. Remit $50 million immediately, or your position will be liquidated. Where can a refinery procure $50 million in cash overnight? They cannot. Therefore, what course of action do they adopt? They cease all new acquisitions. They stop purchasing raw ore from the mines because they are financially unable to initiate a new hedging strategy. And if they discontinue purchasing ore, they consequently halt their production of refined silver bars. This is the direct cause of the supply chain's paralysis. The dramatic price increase has fundamentally disrupted the hedging mechanism that underpins the entire supply chain's functionality. It presents a stark paradox. The higher the price ascends, the less silver is actually produced. We have witnessed similar phenomena in March of 2020 and again in February of 2021. However, the current situation is considerably more severe. In 2020, the price of silver was $12 per ounce. At $62.30, the capital requirements are 5 times greater and the margin calls are correspondingly 5 times larger. The refineries are rendered immobile. Until the market volatility subsides and the price stabilizes, they will be incapable of producing a single additional refined bar. We are currently facing a global production freeze coinciding with a period of peak consumer demand. With the refineries effectively frozen, what is the impact on the subsequent tier of the market, the wholesale distributors? These are the entities that acquire large industrial bars, typically weighing 1,000 ounces, and process them into smaller units such as 1-ounce rounds, 10-ounce bars, and collectible coins. They serve as the crucial intermediary between industrial consumers and the retail investor. When the refineries ceased their order processing this morning, the wholesale distributors entered a state of panic. I engaged in a conversation with a source at a prominent minting facility located in Florida merely 2 hours ago. He described the prevailing atmosphere as apocalyptic. He stated, "We have accumulated orders for 500,000 ounces from retail purchasers who capitalized on yesterday's price breakout. We have received their payments, but our primary supplier has just canceled our scheduled delivery for next week. Consequently, we are facing a deficit of 500,000 ounces. We are technically insolvent if we cannot secure the necessary metal." This is the concealed reality of the bullion industry. A significant portion of its operations relies on a just-in-time inventory system. When you place an order through an online platform, the dealer frequently does not possess the specific item in stock. They, in turn, place an order with the wholesaler who then orders from the refiner. This intricate chain has now been broken. The operator in Florida faces 2 primary options: either refund your money, returning your fiat currency, which is steadily losing its value, or delay the shipment, leading to the dreaded allocation notification. We are observing an extensive application of the latter option today. If you examine your electronic mail, you may discover a notification citing unprecedented demand, resulting in a delay of your order. The projected shipping timeframe is 4 to 6 weeks. The underlying message is, we do not possess the silver. We are either hoping for a price reduction that will enable us to acquire it, or we are relying on the refineries to resume operations. However, here is the critical point. While the wholesale distributors are struggling to fulfill orders, industrial consumers are actively acquiring inventory. Companies like Tesla, Samsung, and First Solar do not purchase individual 1-ounce coins. They procure large industrial bars directly from secure vaults, and at the price of $62.30, their objective is not hedging, but stockpiling. They are acutely aware of the refinery freeze and fully comprehend the operational mechanics I have just explained. They understand that if the refineries cease production for an extended period, the assembly lines for solar panels will halt. This outcome is simply unacceptable. Consequently, these industrial giants are circumventing the wholesale distributors. They are offering premiums that the retail coin dealerships cannot possibly match. They are prepared to pay $65, $70, or even $75 per ounce for immediate delivery of industrial bars. This practice effectively siphons off the remaining liquidity from the retail market. The wholesale distributors are being outbid by technology conglomerates. You are now engaged in a competition for silver against entities led by individuals like Elon Musk. Who do you believe will prevail in such a bidding war? This contagion is spreading with alarming rapidity. By next week, I project that 80% of the online inventory currently visible will be marked as sold out. The remaining 20% will carry premiums exceeding 50%. You will observe a spot price of $62, while silver eagles are priced at $100. This is not an exaggeration. It is the direct mathematical consequence of a severely fractured supply chain. We must now address the legal ramifications. The crucial term you need to internalize is force majeure. This is a French legal concept signifying a superior force. Within contract law, it functions as a clause that permits a party to disengage from contractual obligations due to an unforeseeable event rendering performance impossible. Typically, such clauses are invoked in situations involving armed conflict, natural disasters, or acts of God. However, embedded within the fine print of nearly every bullion dealership agreement and futures exchange contract is a provision that classifies market dislocation or extreme volatility as a valid justification for invoking force majeure. With silver trading at $62.30 and refineries completely immobilized, we are perilously close to declarations of force majeure. What does this imply for you? If you hold unallocated silver within a pool account, if you possess shares in an exchange-traded fund like SLV, or if you are involved in a futures contract and the counterparty declares force majeure, they are absolved of the obligation to deliver the physical silver. They may elect to settle your contract in cash, and they will determine the settlement price. Consider this hypothetical scenario. Silver escalates to $100 next week. The dealer or financial institution invokes force majeure due to their inability to source the metal. They then issue you a check for the value of your account based on the closing price of December 10th, which was $61.75. Silver is trading at $100, yet you are compensated at $61.75. You incur a loss of $40 per ounce and forfeit the actual metal, and this is entirely within legal bounds. This is precisely why I have vehemently advocated for years, if you do not physically possess it, you do not truly own it. At the current price of $62.30, counterparty risk represents the most significant exposure you face. The financial system is actively seeking an exit strategy. Force majeure is that designated exit. We are already witnessing preliminary indicators. The Shanghai Gold Exchange has just increased its margin requirements to 20%. The Commodities Exchange is highly likely to follow suit with increased margins tonight. These represent preliminary safeguards. Force majeure constitutes the ultimate safeguard. If the refineries remain closed for another week, and if the margin calls are not met, we will witness the first significant default. It may commence with a smaller mint, followed by a regional financial institution. However, once the initial domino falls, the wave of cash settlements will commence. You do not wish to be a creditor to a bankrupt bullion dealer. You aspire to be the proprietor of the physical asset. This brings us to the emergent reality of the market. We are observing a profound divergence. For the past 40 years, the spot price and the physical price of silver have been inextricably linked, moving in tandem. Certainly there has been a minor premium, perhaps $2 or $3, but at the price of $62.30, they have effectively separated. The spot price is rapidly becoming irrelevant. It is a numerical representation on a screen, potentially referencing a 5,000-ounce bar that may no longer exist, traded by high-frequency trading algorithms. The actual price is what can be negotiated in an informal transaction. It is the price that a solar manufacturer agrees to pay a refinery. It is the price you pay your local coin shop. Currently, that price is closer to $80. If the spot price is $62 and you cannot acquire silver for less than $80, what is the true price of silver? It is $80. The displayed price is deceptive. This disparity is perilous because it misleads you. You observe the screen, noting a price retraction to $61 or $50, and you conclude, I will wait for a better buying opportunity. However, the premium for physical silver has concurrently increased by $2. Therefore, despite the spot price declining, the actual cost of acquisition has risen. This phenomenon is known as backwardation in the physical market, signifying that immediate possession of the asset is valued considerably higher than the prospect of future delivery. Why is this occurring? Because trust has eroded entirely. No one places confidence in the commodities exchanges to fulfill their obligations. No one trusts the refineries to reopen promptly. No one trusts the stability of the dollar's value. When confidence dissipates, premiums surge. We have witnessed analogous situations in Venezuela and Zimbabwe. When a currency collapses, the price of gold and silver does not merely increase, it vanishes from official markets and is traded exclusively on the black market. We have not yet reached that extreme, but the cessation of orders at major refineries represents the initial step toward this black market phase. Official channels are becoming increasingly congested. Unofficial channels are where the metal is now transacting. If you are not presently integrated into the physical silver market, If you continue to rely on the ticker displayed on financial news channels, you are observing a phantom. For those just joining us, allow me to reiterate with absolute clarity what we have established in the initial segment. The operational framework of the silver market has fundamentally failed. Refineries have suspended orders due to the collapse of their hedging capabilities. Wholesale distributors are canceling retail deliveries because they are unable to procure the necessary metal, and the spot price of $62.30 is rapidly transforming into an illusory figure. We have now passed the point of no return. In astrophysics, the event horizon represents the boundary surrounding a black hole, where the gravitational pull becomes so immense that not even light can escape. Once this threshold is crossed, reversal is impossible. You cannot redirect your trajectory, nor can you transmit a distress signal. You are irrevocably within the gravitational well. The silver market breached its event horizon this morning at 9 Angoras AM, when the major Swiss refiners ceased responding to telephone inquiries. So what lies ahead? If you believe the chaos of the past 24 hours was extreme, you have witnessed merely the prelude. What follows is the phase of unobtainium. Within the next 40 minutes, I will delineate the trajectory of this escalating crisis. I will explain a subtle market shift that is poised to precipitate the most significant stock market bubble since the dot-com era. I will expose the government's inevitable response, the regulatory measures they will implement to staunch the financial hemorrhaging, and most critically, I will provide you with a definitive roadmap to $100, not as a theoretical projection, but as a mathematically assured outcome driven by the systemic breakdown we are currently experiencing. Prepare yourselves. The period of relative ease has concluded. The arduous phase is now commencing. To comprehend silver's trajectory beyond $62.30, you must abandon your perspective as a trader. You must adopt the mindset of a survivalist. You must grasp the psychological implications of unobtainium. Unobtainium is a term employed in engineering and science fiction to denote a material ideal for a specific application but virtually unattainable. When a commodity transforms into unobtainium, its price trajectory becomes vertical. It does not merely increase by 10% daily, it doubles, then doubles again. We witnessed this phenomenon with rhodium in 2020. Rhodium is an essential component in catalytic converters. Supply contracted, manufacturers panicked, and the price surged from $2,000 to $29,000, a 14-fold increase. The rationale was straightforward. Automotive companies required it. Without rhodium, they could not sell their vehicles, many priced at $50,000. Consequently, incurring the expense of $29,000 for a single ounce of rhodium was deemed a bargain compared to the catastrophic cost of shutting down production lines. Silver has now entered this critical phase. Consider the solar energy industry. I've alluded to this previously, but let us delve deeper. A TOPCon solar panel manufacturing facility operates continuously, 24 hours a day, 7 days a week. The capital investment required to establish such a facility amounts to billions of dollars. It employs thousands of individuals, and it holds contractual obligations with governments to deliver gigawatts of power. If the supply of silver paste is interrupted, the factory ceases operations. Employees are furloughed. Contracts are breached. The stock value of the solar company plummets. Government intervention ensues. Therefore, what is the procurement manager at First Solar doing at this precise moment? They are scrutinizing market data. They observe the price of $62.30. They contact their supplier. The supplier informs them, "We have no inventory." Does the manager respond, "Oh well, we suppose we will have to wait"? Absolutely not. They will exclaim, "I do not care about the price. Find it." They will contact competitors, reach out to vaults in London, and even engage with private hoarders. They will offer $70. If that is rejected, they will raise their offer to $80. If still unsuccessful, they will escalate to $100, and only then might they secure a commitment. This is how a price can instantaneously transition from $62 to $100 overnight. This is not driven by speculation, it is fueled by existential urgency. The retail investor, you and I, experience the sensation of FOMO, fear of missing out. The industrial consumer, however, experiences FOTO, fear of terminating operations. photo is a significantly more potent emotional driver than FOMO. We are already receiving initial reports that companies like Samsung and LG are directly approaching mining corporations to secure their entire mine production. They are actively attempting to bypass the refineries entirely. They are offering direct financing to the mines in exchange for guaranteed future delivery. This is the ultimate indicator of unobtainium. The supply chain is being fundamentally reconfigured in real time. And what is the consequence for the price during this phase? It becomes inelastic. This means that regardless of how high the price escalates, the purchasing activity does not cease. Typically, elevated prices naturally curb demand, leading to a reduction in purchases. However, one cannot simply cease purchasing a material that is fundamental to the ongoing operation of their civilization. At $62.30, we are at the foundational stage of the unobtainium curve. The widespread panic buying has not yet fully commenced. Await announcements from companies like Apple detailing delays in iPhone production due to silver shortages. Anticipate the United States military invoking the Defense Production Act to secure silver for missile systems. Only then will you witness the true scale of a commodity mania. Now let us examine the secondary phase of this wealth redistribution. If you are unable to acquire physical silver because refineries are inoperative and you cannot purchase futures contracts due to prohibitive margin requirements, where will the capital flow? It will inevitably direct it to the primary source, the mining companies. For the past decade, silver miners have represented the most disparaged sector on Wall Street. They have been starved of investment capital, subjected to systematic short selling by financial institutions, and traded at valuations that defied rational analysis. It was possible to acquire a silver mining operation for less than the cash reserves it held. However, today, with silver trading at $62.30, the economic viability of mining has transformed into a lottery ticket. Let us conduct a financial calculation for a hypothetical mining company, which we will designate as Apex Silver. Apex Silver produces silver at an all-in sustaining cost of $20 per ounce. This figure encompasses all operational expenses, including fuel, labor, exploration, and taxation. At the previous price of $25 per ounce, Apex generated a profit of $5 per ounce, representing a challenging but viable business model that barely sustained operations. However, at $62.30 per ounce, their operational cost remains approximately $20. Their profit margin now stands at $42.30 per ounce. This signifies an 800% increase in free cash flow generation. Has their stock valuation mirrored this increase by 800% yet? No, because the market's response is typically delayed. The market is often slow to react and may initially exhibit skepticism regarding the sustainability of this price level. However, once the quarterly earnings reports are released and Apex Silver announces a profit for the fourth quarter of 2025 that surpasses their cumulative earnings from the preceding 10 years, the stock chart will depict a dramatic upward trajectory. Furthermore, the refinery shutdown actually benefits the mining companies. How so? Because the miners possess the raw ore. If the refineries are unable to hedge their positions, the mining companies effectively become the strategic stockpile. Major industrial consumers like Tesla and Samsung are poised to directly engage with Apex Silver, potentially acquiring the entire mining operation or securing a 50% equity stake. We are on the cusp of an unprecedented era of mergers and acquisitions with technology firms, automotive manufacturers, and sovereign wealth funds aggressively acquiring mining entities. This influx of capital is set to ignite a supercycle for mining equities. For those who missed the initial surge in physical commodities and find themselves holding cash without viable investment opportunities, mining stocks represent a crucial lifeline. However, a significant cautionary note is paramount. Discerning selection is imperative, as not all mining operations are created equal. Some companies have strategically hedged their future output, entering into contracts last year at a price of $30 per ounce, rendering them ill-positioned to benefit from the current price appreciation. The discerning investor must seek out unhedged miners whose profitability is directly tied to the prevailing spot market prices. Furthermore, jurisdictional risk cannot be overlooked. Consider Mexico, the world's leading silver producer, with prices currently hovering around $62.30. It is improbable that the Mexican government will permit foreign entities to retain all of these substantial profits. Indeed, there are already circulating rumors of extraordinary profit taxes being imposed in both Mexico and Peru, with nationalization potentially being the next consequence. Consequently, mining ventures situated in secure jurisdictions such as Canada, the United States, and Australia will undoubtedly command a significant valuation premium. The shift in focus towards mining is commencing now, with astute investors transitioning their capital from bullion dealers experiencing stock shortages towards the more liquid mining exchanges. This is precisely where the next tenfold return on investment opportunity resides. A critical discussion is warranted regarding the inevitable countermeasures from established powers. One should not delude themselves into believing that entities like JP Morgan and the Federal Reserve will passively accept such a market shift, nor that they will allow silver to reach $100 without a formidable defense. Having lost the battle for market control, they are now poised to initiate a regulatory conflict. We witnessed a similar scenario in 1980 with the Hunt brothers, when regulatory bodies altered the trading rules, implementing liquidation-only orders and prohibiting new purchases, confining transactions solely to sales, while simultaneously escalating margin requirements to 100%. It is highly probable that a comparable sequence of events will unfold, potentially within days. The forthcoming playbook, designed to suppress prices from $60.30 to $30, will likely involve several tactics. The first, termed the margin nuke, will see the CME Group announce an emergency increase in margin requirements. What may currently necessitate $10,000 to control a contract could escalate to $50,000 or even $100,000, aiming to force smaller speculators and retail traders out of the market by making positions unaffordable. The second tactic, position limits, will involve the Commodity Futures Trading Commission declaring a market emergency, asserting that speculative trading is distorting prices. They will then impose caps on the number of contracts any single entity can hold. However, herein lies the inherent corruption. Commercial hedges, primarily banks, will likely be granted exemptions, allowing them to maintain short positions while preventing others from going long, thus perpetuating a rigged system. The third tactic, the windfall tax threat, will see politicians appearing on television decrying hoarders as obstacles to the green energy transition, labeling silver accumulation as economic terrorism or price gouging. Proposals to restrict precious metal sales will emerge, designed to instill fear and encourage divestment. The fourth tactic, ETF cash settlement, draws parallels to force majeure events. Investors should closely monitor the iShares Silver Trust, SLV, as its prospectus could be amended overnight. Citing fund stability, they might suspend the creation of new baskets, effectively decoupling the ETF from the physical price. The ETF could then trade at $50 while physical silver commands $70, trapping passive investors. It is crucial to be prepared for such announcements. When these unfold, the price may experience sharp declines. Silver could plummet from $60 to $55 within an hour on the news. The media will undoubtedly proclaim the bursting of a bubble and government intervention. Do not succumb to this narrative. Regulations cannot magically create silver, nor can margin hikes or taxes manufacture it. These maneuvers serve only to diminish paper demand, doing nothing to alleviate the fundamental physical shortage and, in fact, exacerbating it. Taxation encourages concealment, further reducing available supply. The prohibition of speculation will merely shift price discovery to the black market. The true price of silver is no longer dictated by the CFTC, but by the physical deficit. Unless governments can conjure 1.1 billion ounces out of thin air, their power to influence the physical market is negligible. Their actions can only generate volatility, not alter the underlying trend. Therefore, when the regulatory hammer inevitably falls, view it as a testament to their desperation and the death throes of a failing system. Despite refinery disruptions and impending regulations, How will we reach $100 per ounce? Let us delineate the progression. We are currently at $62.30, representing the breakout zone. Stage 1, the gamma squeeze, projected to move prices from $62 to $75, is already underway. Millions of call options are in place at strike prices of $65 and $70. Market makers, having sold these options under the assumption they would expire worthless, are now compelled to hedge their positions by purchasing futures contracts as the price ascends. This escalating demand from market makers to cover their option obligations, known as gamma, creates a self-reinforcing upward spiral, propelling prices rapidly through the $60 range. An expectation of reaching $75 within the next 10 trading days is reasonable. Stage 2, media mania, is anticipated to drive prices from $75 to $85. At $75, silver will become a prominent news item, extending beyond financial channels to mainstream evening broadcasts. Silver will achieve record highs, prompting widespread public interest, with individuals previously uninvolved in market dynamics drawn in by the rising price. This influx of capital, often described as massive and dumb, will fuel momentum-driven price increases from $75 to $85. Stage 3, industrial capitulation, will see prices ascend from $85 to $100. This marks the final ascent. At $85, industrial users will acknowledge the price trend's permanence. Temporary surcharges implemented on their products will become standard. Rather than resisting the elevated price, they will engage in panic buying, potentially issuing corporate bonds solely to secure silver supplies. This institutional purchasing power will overcome final resistance levels, driving the price upward incrementally through $88, $92, and ultimately to the psychologically significant mark of $100. The rationale for $100 lies in its appeal as a round number, akin to the 4-minute mile. Crossing this threshold will signify a global paradigm shift, repositioning silver from a mere subordinate to gold into a premier monetary asset. At $100, the gold-to-silver ratio is projected to collapse to between 40 to 1 and 30 to 1, necessitating a revaluation of the entire asset class. Thus, the roadmap is clearly defined. A gamma squeeze propelling us to $75, public enthusiasm driving us to $85, and industrial panic culminating in $100. This trajectory will not be linear. Expect corrections of 20% and periods of intense volatility. However, the ultimate destination is mathematically assured by the persistent deficit. This leads to the most critical yet often overlooked question: when does one sell? After years of holding, witnessing the ascent to $62.30, and now potentially reaching $100, the impulse to sell for dollars may arise. Herein lies a controversial perspective: do not sell silver for dollars. Why exchange the planet's most scarce asset for a currency undergoing relentless inflation through continuous printing? If silver reaches $100, it signifies a substantial devaluation of the dollar and rampant inflation. Selling for cash in such a scenario is akin to acquiring a worthless ticket. How then does one realize profits? Through strategic swaps. Strategy 1. The gold swap. When the gold-to-silver ratio falls below 30, meaning it requires only 30 ounces of silver to acquire 1 ounce of gold, initiate a swap. Exchange volatile silver for the relative stability of gold, thereby preserving purchasing power gains without reverting to fiat currency. This effectively multiplies one's gold holdings without additional investment. Strategy 2. The asset swap. Exchange silver for tangible assets such as land, income-generating rental properties, or ownership in a business. This represents a transition from defensive wealth preservation to productive asset accumulation. In 1980, approximately 800 ounces of silver could purchase an average American home. Today, at $62 per ounce, this ratio remains skewed. However, at $100 or $150 per ounce, this equilibrium will be restored. The point at which a house can be acquired for a single monster box of silver represents the optimal exit point, not for abstract numerical gains, but for tangible, income-producing assets. Avoid fixation on dollar figures. $100 is merely an indicator of the dollar's diminished value. The ultimate objective is the preservation and expansion of purchasing power. We are living through a pivotal moment in history. Thursday, December 11th, 2025. The day refineries ceased operations, the supply chain fractured, and $62.30 solidified as the new price floor. The nightmare scenario described is not a fear-mongering tactic, but the stark reality of a market devoid of physical buffers where the 11 billion ounce deficit has finally materialized. For those who heeded the warnings and prepared, having acquired silver when prices were around $25, they are now secure. They have effectively become their own central banks, holding the insurance policy the rest of the world is desperately seeking. To those still on the sidelines or awaiting a market correction, this is a final message. The opportunity for easy acquisition has passed. One might find isolated ounces here and there, perhaps through luck at a local pawn shop, but the era of readily accessible silver is over. We have entered the age of unobtainium. Do not allow market volatility to deter you, nor government pronouncements to instill fear, nor the paper price to distract from the physical reality. The banks have lost their grip. Industry is engaged in panic buying, and the price is converging towards its true value. Maintain your resolve, safeguard your holdings, and observe the unfolding events. This represents the most significant wealth transfer in human history, and you are positioned on the correct side of it. Subscribe.